Before we get started, I just want to make a reminder to everybody that the information discussed today is not to be interpreted or construed as investment advice. Everyone's financial situation, goals, and objectives are different. Please consult investment advice.
The dirty secret is that no one's ever going to get paid back.
People have the shortest memories when it comes to investment.
We just got to get Keith into Bitcoin.
Hey, there's a bubble. Welcome back to Loonie Hour, episode 34. As always, joined by the three amigos. We've got Rich Diaz, the Tom Brady of Macro, Acorn Macro Consulting, and we've got everyone's favorite boomer, Keith Dicker with IceCap Asset Management. Welcome back to the show, gentlemen. Lots to talk about this week. Should be a great episode. But let's start it off with what everyone was probably looking forward to, paying attention. We had the Twinkie bet on the line. Of course, we all had 50 basis point rate hike from the BOC consensus. And, you know, it was kind of a bit of a snooze fest. So, June 1st, Bank of Canada raised rates 50 basis points. So really nothing shocking there, really just kind of status quo. I think they've set themselves up for what looks like another 50 basis points. I believe it's mid-July. I don't know if anyone's got that in front of them, but so we'll have another probably 50 basis points in July. There was no press conference following Tiff Macklem's comments, so we didn't really get to hear from the big boy there, but we did get some updates today from sort of one of his chief of staff there. I don't know what you'd call him, but he's definitely coming out a little on the more hawkish side. Beaudry, is it Tim or Tom? Timbo, I don't know. Doesn't really matter. He sucks. Anyways, he's basically, came out with a pretty hawkish statement. Beaudry says Bank of Canada is resolute to bring down inflation. Bank of Canada indicates policy rate may need to move past 3%. Of course, we're at 1.5% right now. More likely rates rise to top of the neutral range or beyond. And pretty hawkish statement. Keith, I don't know if you had any comments, anything that you're looking at based on that 50 basis points move. Obviously, we'll, unpack this thing a little bit further, but curious your thoughts.
Well, first of all, I was the only guy in the world waiting for the presser to start, which I discovered very quickly. There was no presser yesterday. And so that was fun. So when there's no presser, no opportunity for Q&A, you don't get to, fill in the blanks, in the lines of the statement that comes out. So, again, we always encourage people, if you have a chance to hop on, listen to the Bank of Canada presser when they have it, or the Fed or the ECB. It's really interesting to hear how they interact with people asking questions, and you never know, something unexpectedly comes out. But yesterday here in Canada, that opportunity wasn't there. And so the next meeting is July 13th that you're asking about there, Steve. So because there's no presser, then everybody who has access to the statement, they'll try to analyze it and interpret it this way or that way. The one interesting point that came out, one or two guys, and then it starts to snowball a bit. They're now suggesting that the Bank of Canada is hinting that they might raise rates by 75 basis points at the next meeting. So we'll see. Maybe that's the Twinkie bet coming up.
I've got $100 bet with a Twitter follower. Actually, we bet $100 on June 1st. He was betting for 75 beeps, so I won that, a friendly donation to the SBCA, and I have another one with him, same guy, for July. He's also doubling down on his bet for 75 beeps. So. The SBCA is really the benefactor of all these rate hikes right now. But Keith, I actually had a question for you because you said on Twitter, and you never responded to any of the tweets, but you said you had you said, can you connect me with a reporter? Because I have a really good question for them to lob to the Bank of Canada. I don't know if you're able to share that.
You can do a role-playing game. Keith can ask the question, and I can pretend I'm Tiff Macklin.
Okay, let's shoot with that. It sort of ties in like the whole conversation that So before I get into that, I will tell you the question that we have, and it's not meant to be a funny or quirky question or a gotcha moment at all. Nothing like that. It's because again, not all of us have access to the central bank guys for the pressers. So it is really tough to get in there. And sometimes the questions that are asked, they're expected, right? But just carrying on real quickly though with the Bank of Canada, now they're, for some reason, some of the analysts are saying, hey, 75 basis points on July 13th. That would be an incredibly big, shocking event if that happened. So just as a couple of months ago when they did 0 rate hike, because I think Rich Diaz was the only person in the world who said they wouldn't raise rates, and everyone else thought they were going to. If they do 75 at the next meeting, then it's that kind of moment. But they were very hawkish with everything they said in this statement, and we'll continue to go down that path. What's also interesting is that this week, over the last week, a lot of the members of the U.S. Fed, or the Federal Open Market Committee, they've been out discussing the same concepts. Now, I just want to explain something that's really important for everyone to understand the way the Fed is set up. It's a big collection of a bunch of individuals. I won't go into how it's set up, but it is set up this way. But there's a rotating basis on who gets the vote on the policy, on the monetary policy. And then other people, they attend all the meetings, but they're not allowed to vote. They're sort of like alternate members, and the schedule is on the internet. You can see, like, for example, I think this year the Federal Reserve Bank of Atlanta, that's one of the guys, he is not a voting member. I think next year he'll roll back on and stuff like that. You have to know who has voting rights and then who doesn't when they're out there talking their book. So this past week you had Bostic, he's with the Atlanta Fed. And then you had Waller. I don't know who Waller's with. It might be Richmond, something like that. So Waller was incredibly hawkish this week, saying, yeah, we need to be very aggressive hiking rates. Maybe we'll hike even more than what the market is expecting, similar to what the Bank of Canada came out with. And then you had this other guy, Bostic. He's gone the opposite. Said, maybe we should pause at the next meeting. Maybe we don't need to raise rates enough. And again, like, you have two of them out there, the strongman poll, like they're trying to get, the market sort of leaning on each side, trying to make people feel a bit more comfortable maybe. But you ignore what Bostic is saying, and you have to watch what Waller is saying. What Waller is saying, hey, we're going to continue to raise rates and we'll be aggressive about it. And that's the same message we got from the Bank of Canada yesterday. We'll also jump over to the ECB in a little bit. Back to the question though, for the my famous Twitter feed. By the way, one person replied. I think they were able to make an introduction for me, but there was no presser, so it was kind of stupid on my side. It's come to my attention. So now with the Americans, their balance sheet is $9 trillion. So you find that online. It's like 8.9 something.
So that's up. That, I think, just for context, that's up from, I believe it was 1 trillion pre-global financial crisis, and so now we're at 9.
Yeah, it's gone from 1 to 9, like over about 13 years. And so just an incredible, if you see, I think I have the graph on my Twitter feed, I pushed it out. And now they're starting, I think it's next week, they'll actually start unwinding the balance sheet, which is a big important event that's taking place. And then one of my friends in the network, he sent me a private note and he said, by the way, Keith, the number is actually 12 trillion. I'm like, where are you getting the 12 from? He said, well, we know there's another 3 trillion in credit swaps that they have on their books. So what that means is that the Fed, the big banks out there have taken credit risk off their balance sheets, and they've written, in my world, we call it an OTC or over-the-counter type contract, which is off balance sheet. So it doesn't show up in your official books anywhere. But the Fed has taken another 3 trillion of risk, from the banks. So then I said, what do other central banks, are they doing this as well? And he said he doesn't know for certain, because we like to deal with, with facts in terms of what you're told. But it suggested to him that, most likely the Europeans are doing this. So my question would have been for the Bank of Canada, do you guys have any credit swaps off balance sheet for the Canadian banks that's not disclosed?
Boom.
Yeah, which has been a really interesting question. No, they would
Get
know
the hell out of the room.
They would know what it is, of course. But
Yeah,
again, those are the kinds, when we get into extreme moments, that's what central banks are doing.
So do you think, sorry, Keith, do you think that they do? Do you think that they do?
I don't know. I don't like to make a guess. You know, I like to see what's the probability of it.
Yeah.
You know, I know they bought mortgages from the banks there a couple of years ago. They did that. They provided other kinds of support. But I don't think the Canadian banking system has been in that same situation of the American system. So if they did, it would be like an incredibly large surprise for everyone. If they didn't, it shouldn't be. But the point is, though, those are the kinds of questions that should be asked.
You're going to get a shadow banned here.
Yeah, our viewers dropped from 12 down to 3.
My mom won't stop listening.
God bless her. What's Rich? What do you got? Any commentary on this?
Yeah, I think two things I thought really stood out for me. One was that we're back to the 29. We're almost back to the 2019 high of 1.75 on the main policy rate, which sort of, I know this sounds silly, but it sort of snuck up on me. I don't know why, but I just was like looking at, I was updating my chart pack and I just like, we're 25 basis points away from where we were sort of in 2019. And yet the entire world is collapsing around either real estate markets. You're seeing editorials come out. I mean, I read one, but it just made me crazy about how, you know, we need to pump the brakes on the rate hikes and this and that. And, you know, meanwhile, real interest rates, which is adjusted for inflation, you know, continue. I mean, some measures, it continues to sort of get lower and lower. It is certainly very negative. And so I just was like, you know, I feel like the messaging somehow versus the reality sort of split for me in a way that just, I know it's silly for me to admit, but it's true. It just sort of caught me off guard, even though I look at this shit every single day. And so, yeah. So, and then just to give some more context, you know, the previous high before that was in 2009 and it was about 4.5. End of 2008, 2000 was at 4.5. And there, real interest rates, it was the last sort of time real interest rates were positive. It's not a coincidence that we have a huge housing bubble after real estates are negative. That's a conversation for a different day. The other thing that stood out for me was it's sort of an admission of guilt, I think, what we're seeing. And it's kind of welcome as far as I'm concerned. I think when you screw up, and I screw up all the time, not all the time, but fair enough, it's important that you just say, I screwed up, and you work to correct it. Acknowledge the problem and move on. And I think that them flirting with the idea that they want to raise interest rates by 75 basis points, I think is sort of an admission of guilt. I'm not exactly sure they'll ever come out and say it, but to me, I think that, you know, reading between the lines, that was my takeaway. And then obviously seeing Janet Yellen come out and literally admit guilt with respect to getting the inflation thing wrong. You know, now Republicans in America are like, you know, mocking her and saying that she should be kicked out of office and blah, blah. I disagree. I think she deserves a round of applause. I think if more central bankers and more governments came out and said, we screwed the pooch, here's what we thought it was a good idea, we were wrong, we're adjusting our thinking, our belief, our understanding. You know, there's like a great John Maynard Keynes quote, you know, it's like, when the data changes, I change my mind. What do you do, sir? And I think that this idea that you should be admonished or made fun of for changing your mind or admitting that you fucked up, I think is a terrible precedent to set in our technocrats at the minimum, and definitely in our politicians. Well, so I think that the fact that Janet Yellen came out and said that, I think is a great thing, frankly. Sorry, Steve, go ahead.
Well, I mean, that's a good point to interject, because I admittedly, obviously, you know, as we're dunking on Scotiabank for 8 rate hikes at the beginning of the year. We're now at, technically, I guess we're at 5, because there's those 250s plus the 1.5. I think we had 3 or 4. So it's too early to me to give them a victory lap. I mean, Scotiabank also said that they were not going to see a decline in house prices, which I'll touch on briefly. So they might actually get it right to 8, but I think not without crumbling, as we talked about, you know, crumbling markets. And I think that we're already seeing that, particularly here in the Canadian housing space. Because, you know, just a quick stat for everybody. So depending on where you are, like obviously I'm in Vancouver. So if we look at the suburbs of Vancouver, which is, we call it the Fraser Valley, That's really where most of the speculative froth was. The pandemic, everybody worked from home, so move 45 minutes out from the city. May home sales just came in, so they were down 54% year over year. 54%. That is like a tremendous drop. I know that we're talking about a year over year base effect of like record home sales last May, but to see volumes get cut in half, like that's going to hurt, because you have to think about it from the perspective of like, I just work in the industry, so I see it, which is like all the hiring that's been happening over the last like 12 to 18 months. Cause everyone's like, so every realtor now like has a full-time assistant. Every big bank is, I was just talking to one of the big banks. They doubled their mortgage broker count over the last 12 months. Like always at the top of the market. So like, like now all of a sudden, like the volume's drying up, like those people are going to be the first to get cut. And same thing for like developers, right? Like they're aggressively hiring trades and getting shovels in ground. So I just think like the knock-on effects we're seeing, and it's funny because like we talk about a 54% drop in the Fraser Valley in Vancouver here, but like the suburbs in Ontario are horrendous. That's where most of the bloodbath is, and that's really Canada's most systemically important housing market. My good buddy Ron Butler, who runs Butler Mortgages, they're like one of the largest broker channels in Canada. And he's telling me that 50% of mortgage appraisal values are coming in below what people are paying. Like to have a 50% failure rate on mortgage appraisals in Ontario is catastrophic.
Sorry, what does that mean?
So basically, so you buy a house for $1 million, right? So you have an accepted offer. Maybe you have subjects in there, maybe you don't. Most of the time, they now usually have subjects now. So you make an offer to purchase for $1 million, and the appraiser goes in there to appraise the value to confirm the loan, and he says, it's only worth $950. Sorry, sir. So now you have to either renegotiate that contract with the seller, or you have to come up with a larger down payment, or you simply just back out of the contract. Again, you can only back out of the contract if you have that subject clause in there, which allows you to. So we're just seeing it's basically just a further tightening of like financial conditions.
Sorry, can I ask one more dumb question? What authority does the appraiser have? Like if you and I agree on a number, one, isn't that the only number that counts? Like why is the appraiser allowed to come in and say, no, that house is only worth 0.5?
So the appraiser is basically hired independently as a third party by the bank. The bank actually now, I think OSFI brought this rule in 3-4 years ago, the Canadian banking regulator, where they said, you as the mortgage lender, Mr. Smith, who's the mortgage broker at RBC Bank, he cannot handpick his appraiser because there's probably a conflict of interest there. So what happens is it goes through the system. So the broker just says, okay, we need to order an appraisal for the bank. And the appraiser goes out to this third party appraisal company. And so now the appraisal companies are obviously like skittish. They're like, well, market's kind of dropping. So they're being really conservative in their valuations. And so the bank only wants, like, at the end of the day, it's like your house, everybody thinks I own the house. Like the bank owns the house. So they don't want to lend, for example, if the house is only worth $950 in the appraiser's eye and the independent eye, then they only want to lend, 80% of $950.
Can I give you a tiny story about how I got my flat
mortgage fraud?
No, this is a true story. So I came up to a couple of years ago. I came to the end of my 5-year fixed mortgage, and I call up my mortgage broker. Lovely guy. He's done very well for himself. And then he's like, "So Rich, what do you think your loan to value is?" And I was like, "I don't know. I don't think the prices have gone up in 5 years." And he's like, no, that can't be right. And then he's like, I feel like there was a house sold like 2 months ago in your area. Let's call the real estate agent. So he like puts me on hold, puts the guy on speakerphone, calls him. He's like, so what was that house? Oh yeah, okay, such and such number, such and such square foot. Rich, how big's your house? I tell him. He's like, okay, great. And that was it. That was I swear, that was the appraisal. And so loan to value went down, right? Your loan to value went down, which improved my ability to get a much cheaper rate on my mortgage, and the rest is history. But that was my only experience with having an appraiser. So I was sorry. That's why I had.
Yeah, no, I mean, what's the funny thing is though, is like the appraisals never, ever miss. Like, okay, maybe like 1 out of 1,000. The appraisals almost never miss in the bull market, right? Okay, like there's no price too high that you can pay where like the appraiser is like, yeah, last house sold for 1.3, you paid 1.6, must be worth 1.6, like rubber stamp. But like now that the tide is going
And the
out, like,
sentiment.
oh,
Right.
yeah, it's just, it's kind of typical of obviously, bull markets and the cyclicality of financial markets, right?
And what's happening in Brampton?
Oh God, yeah, don't bring that up again. We're gonna avoid that topic for the sensitive listeners here that we have, some of them. But yeah, I don't know. Like, I mean, we'll have to see how this plays out. Like I said, obviously, 50 basis points coming here in July. Do you have an updated thing, Keith? Because I'm just looking at one of my bond trader friends here sent me some notes here. So he was saying that the market is pricing, and I'm not sure which market he's referring to in terms of, I know there's different ways to value rate increases, but so he's got the market's now pricing in a 2% overnight rate by July 13th. So that's be another 50 basis points, basically 2.5% by September, 2.8 by October. So basically they're predicting year end for the rate to finish at 3%. So the BOC will finish at 3. So again, we're at 1.5 right now. So we will see effectively a doubling of rates. At least that's what the market's expecting.
So a few weeks ago, the year-end estimate was like 3.1%. Now it's down to 2.96.
Yeah.
So what that means, it sounds like we're splitting hairs with things, but it just seems that the Bank of Canada overnight rate, it should be peaking at the end of this year. That's effectively what it's saying. So the further out you go is less confidence that they'll continue to raise rates, which sort of ties into something else that we should talk about. But I just want to bring up one more item first with the central banks, because it's so interesting and exciting. So people now, you're probably aware that, central banks were doing quantitative easing. That's where they were, buying bonds indirectly buying bonds from the governments. Now they're going to turn to quantitative tightening, which means they're taking the bonds they bought and they're going to, sell them, to the public again. Now, the way bond prices work, when interest rates are going down, the price of bonds go up. And the opposite, when rates are going up, the price for bond goes down. So for the Federal Reserve, for example, they're now in a situation where it's highly likely the bonds that they're going to start selling now, I think it's starting next week, there's the probability they will be taking a loss on these sales, right? So if everyone else, if you have a loss when you sell something, it's a loss, right? It's a negative number, and that's just the way it is. And that's the way the real world should work. Not for the central banks, though, because they have a real challenge in that, first of all, with central banks, when they were buying bonds with the quantitative easing program, every time they received interest from, because they're holding the bond, they get paid interest on it. After they deducted money they needed to run the Fed and stuff like that, the net change was always distributed back to the Treasury Department. So with the Bank of Canada, the interest they were collecting by holding Government of Canada bonds, they basically took that interest and sent it right back to Ottawa so they can spend it again, right? It's an awesome. So in theory, if the Bank of Canada bought enough bonds, they could really, I guess in theory,
don't give them any ideas.
Yeah, they could. So anyway, what I love about the investment world, like this, the creativity is pretty cool sometimes. But what the Federal Reserve, and again, all the central banks have agreed to this, any losses that the central bank will have now from selling their bond portfolio, they actually record it as a deferred asset.
Oh, I'm confused.
Or an asset with a negative sign in front of it, because they're not allowed to have losses.
But they have in the past, though.
No, it's a deferred asset. So
Okay.
I know, like in the Loonie Hour
tricks.
world, people are saying, yeah, like they're saying, who the hell, who cares about all this? But for the Fed, it doesn't matter, because they're unlimited. If someone like the ECB had it, because they're structured extremely differently than everyone else, they actually have a capital paid in account that all the 19 members of the Eurozone, they had to pay into. And all of a sudden, if there are losses, those losses come out of the capital account first. And it could very likely, if it's big enough, if a central bank like the ECB, they bought enough, which they have, of sovereign debt, quantitative easing, then they have in theory, they could have a capital call to the Eurozone members. So just imagine you're Italy, you're in trouble, you're Spain, you're in trouble, Portugal's in trouble. So Rich Diaz goes back to the homeland or set things straight. And all of a sudden you get the tap on the shoulder. Not only are, you're running a deficit, your economy is slowing, there's negative real rates and all that stuff. But all of a sudden, Frankfurt is telling you that, hey, we need you guys to pay an extra, $8 billion, 8 billion euro to get your margin account back up.
And that's interject. Oh, sorry, go ahead.
Well, yeah, but just as in the world today, where people are running into challenges sometimes with the investment portfolios, especially if they're on margin and they're levered and stuff, and they get that, unwelcome phone call or email, hey, you need to replenish your account or you sell everything. Like the world has become so distorted that the central banks have figured out a way not to be exposed to that world. Instead, it's they just spread it out across everyone else to pay for. Sorry, Rich, but that
No, I was just going to say there's another way that they can do that in Europe, which is adjusting something called the capital key. And the capital key is based on more or less the GDP of the euro area. So you've got 19 countries. Let's just say for argument's sake, Germany's 25%, France is 29%. The next biggest country by GDP is Italy, then Spain, and then I think it's either Netherlands or Belgium. I can never remember who's next. So a country like Greece is only 2% of GDP, but it has 4% of the debt in euro terms. So what the sneaky backdoor way of doing it, which would drive Jens Weidmann absolutely crazy. He was the former Bundesbank president before they basically started going bananas. Is that they would just adjust the capital key such that Germany would have to fill in the losses, right? That's the other way that they could do that. But that brings in a whole other political. Anyway, sorry, that was the other thing I wanted to say.
Well, I mean, speaking of the Eurozone, it could always be worse. This is a tweet here from the always insightful Julian Brigden. He says Eurozone inflation is utterly out of control with 3-month annualized rate of inflation running at approximately 16%. Yet the risk-free asset in Europe, aka the 10-year bunds, yield 1.1%. So as we've been talking about on the show, it's not really a conspiracy theory. I mean, that is kind of financial repression at its best, really. I mean, yeah, it seems like inflation is obviously out of control there. Obviously, the Russia-Ukraine war is not helping. I highly encourage everybody to go check out. See if I can maybe link it in the show notes and it for YouTube. But the interview with Peter Zeihan was really insightful, just on the whole war and the energy markets and the. Again, not to sort of, I know we can get Rich fired up here, but really just the lie, which is the green transition. It just like Peter kind of lays it out, which is like, it's funny because he actually says in the interview, he's like, listen, I'm actually like a greenie, like I'm a green kind of like advocate, but he's like this, like the math just does not pencil that the transition is not possible. At least in sort of where they're projecting, which is what, like 2040, sort of like zero, like, this Paris Accord agreement. And so, yeah, I'd really just encourage everybody to kind of go highlight that, because it's really just about like keeping your emotions out of it. Like, yes, we might want to get off carbons and all this and feel good about it and plant some trees. But at the end of the day, it's like he says, right? Like by making this transition, he's calling for, I mean, he might be a little bit extreme, but he believes, 1 billion people might die of famine over the next several years. Again, probably extreme. We don't need to scare everybody here. That's not going to be on the West Coast here in North America, but certainly in some of these third world countries, they're going to be having some extreme difficulties.
You just reminded me, you mentioned Julian Brigden. I just remember Julie and I might go see the 49ers Broncos game this year, and we agreed to What's it you do when you have the can of beer and you puncture a hole in the bottom and you
Shotgun. Oh man, you're old. I love it.
we're on a different chat group together. I was like, hey, Julian, we'll do this. And he's like, how do we do that? And then these young guys like chimed in, well, you take it and do it that way. So if anyone's in Denver in like late October, I think you see two old guys doing that with the beer. It would be us.
Rich,
Make sure you stretch before you guys are gonna hurt yourselves.
someone's gonna have to puncture the hole for them here. Help them
Yeah,
out.
yeah, because I can't reach that high. That's the deal. So let's next then. So Jamie Dimon. So
Jamie Dimon's comments. That was hilarious. Yeah, Keith. I don't know if you want to tell the story. Go ahead. I thought it was pretty funny.
I haven't heard it, so you have to tell us.
Well, I think it's interesting because right now, we've introduced the concept of the storyline that anyway at IceCap, we suspect that the probability of growth slowing a lot faster than what the market is expecting. It is higher. This is what we expect, and now we're starting to see that narrative take place. It's coming out from different places. And anyway, Jamie Dimon came out with the same concept yesterday, the day before, but.
Jamie Dimon, by the way, is CEO of JP Morgan Bank, in case you guys don't know who that is.
Yeah, he has a really interesting story how he became CEO of JP Morgan, by the way. Like, just go in the backstory, you'll find all that. Basically, he got banished to Chicago. So he didn't get his way on Wall Street and he lost out in the power struggle. So he went with Bank One in Chicago for a number of years. And then all the crap happened in New York. And, by default, by him not moving up or down in the industry, everyone else dropped out. By default, he came back in. Now he's leading like probably the most successful, bank in the world. But anyway, Jamie Dimon, he was at an interview or something the other day, and he described the same concept, but he described it saying, listen, a hurricane is coming. He said, you may not see it right now or may not appreciate how strong it's going to be or what the damage it can do. But he was talking about a slowdown in the economy that's coming. And it's sort of interesting because this morning I was looking at, growth estimates for the developed world and the emerging market world. So for this year versus next year, and then on an individual country basis and all that stuff. And so growth is estimated to be lower this year than last year and a little bit lower next year as well. But they're just like small changes. And that's one of our points with the industry. No one has ever forecast a dramatic decline or ascent in anything. It's always you're within that one standard deviation, and stuff like that. But now the fact that more people are talking about the probability of having a pretty good rollovers coming up, including the head of JP Morgan, that just caught my attention. It's
you missed the best part, which is this guy says a hurricane's coming, yet his own analysts at the bank are not forecasting any sort of recession whatsoever. So I don't know.
Let's explain why, though. Let's explain.
Yeah, Rich, I mean, that's why I was gonna defer to you. So please,
show me an incentive, and I'll show you the result. Right. So, we're very critical of these people, rightly so, a lot of the times, and in some cases, we're a bit harsh because you can't be an investment banker and be trying to IPO some stocks, right, for company XYZ, and then have your chief economist be like, oh, but the economy is gonna tank, so the company that we're trying to IPO or the deal we're trying to get made or the funding we're trying to secure for, let's say, a wind energy farm or whatever, you can't have, there's different sort of silos in the bank, and there's supposed to be something called the Chinese wall, which is probably an inappropriate term these days, but between the different, the investment banking sector and the strategists and the broker and the prime broker and all these different groups. And there's supposed to be this this understanding that they're not supposed to communicate. But if the economist comes out and says, by the way, the world's screwed, it's over, the investment bankers are going to have a hard time or be hard pressed to raise the X billion of dollars that they need to get this new company out. And so that's why you got to take these kind of estimates with a very large grain of salt. And independent advisors,
Acorn Macro plug,
are usually a better way of getting that kind of analysis. But just in defense of that business model, I get it, right? I don't know, maybe I'm too naive, but
No, I think that's a great point. I actually kind of wanted to touch on that as well, circle back, maybe get your thoughts. But Keith, you were talking about just like, slow marginal little GDP revisions here and there and whatnot. Do you put any weighting, and Rich, maybe this is a question for you. Do you put any weighting on Canada's most recent GDP print? So the economy expanded 3.1% in the first quarter, but the expectations, the forecast by all the economists was about, the consensus estimate was about 5.2%. So it was a decent sized miss. There's still quite a bit of growth there at 3.1, but I don't know, how much stock do you put into that?
Me, I think that there's a couple of parts of our economy that are doing super well, and it might help GDP in a way that, I mean, don't get me wrong, there's stuff that's, for example, real estate, not great. But, there's other parts that are doing very well, and I'm sure they're adding to it. Our exports continue to go up. Yes, our imports are also going up, which is probably net drag on GDP overall, but that's sort of, that's like an esoteric point. My point is like, it's just two things. One is it's a backward looking indicator. So it's important to remember that. I mean, I think GDP for Germany was 3.4% in Q1. Let's wait until the end of Q2 before we celebrate. So just as a comparable. And then the other thing is that Canada still has an incredible amount of population growth. That's important contributor to GDP. The oil sector is important. The manufacturing sector is doing relatively well still. There's still a bunch of service sector industries that are also doing well. And so I don't know. I think the US is sort of, the Canada is the tail. It'll be, it is a function of other larger, more important economies, and how those do is going to dictate sort of how, and it might be with a lag. And so that's important to just.
I mean, remember. Yeah, I guess from a lag perspective, all you can say is like, so remember Q1 was like the peak of the Canadian housing bull market here, right? So January, February was kind of the top. In March, we just started to slowly taper off. So in terms of showing up in the data, April, May, June are going to be relatively, Q2 is not going to be great for Canadian housing. And I have to think Q3 is going to look even worse. So I guess we sort of look forward. I don't know. My personal base case is I think the economy is going to slow tremendously. And that's pretty much just my own views based on what I see in the housing market.
So there's just one more thing I think in general, and we've mentioned this I think months and months and months ago, and I think in many ways the pandemic is over, although some people in this country would really love it to continue. And in other ways, I think it's important to remember that the pandemic is not over, not in a, hospitalization rate, but like it's the reverberation, when you throw, forgive this analogy, maybe I'm going to garble this, but you have a swimming pool and you throw like some large heavy object in the swimming pool and the waves ripple out, they hit the edge of the swimming pool.
You throw me in?
What?
You're throwing me into the pool?
Sure. We're throwing Keith into the swimming pool. And the waves ripple out and then they hit the edge of the swimming pool and they come back. And I think I still think we're in this, we're still feeling, it's only been, 2 years since, or 2.5 years since China lied about human to human transmission. Right. So it's important to remember that I think that there's, in the same way that 2008, when you look at the NBER, which is the National Bureau of Economic Research, they say that the recession was 2 quarters or whatever. But I submit to everyone that the recession took really, probably 4 or 5 years. I mean, prime age employment took 6 or 7 years to get back to peak. So you can say, Rich, yeah, the recession, 2 quarters of negative GDP growth were in 2008-9. And yeah, some definition devised by some guy sitting in his ivory tower, fine. But I would submit to you that it took 6 years in US to fully recover, to fully shake off the kind of negative side effects of the recession in 2008. In Europe, it was even longer. If you look at real retail sales in Europe, it took almost 10 years to, 8, I can't remember exactly the number, but it took like 7 or 8 years to recover. And I think, we can, and I think that's where we start looking at these numbers, say, oh, it's up, it's down. Let's say we go into a double dip, quote unquote, recession this year, right? We had let's say we have 2 quarters of negative growth, isn't in my view, I think what's more important is that analogy where you have the wave go out and then the wave come back in, and we're still letting the water sort of settle as Keith sinks to the bottom of the swimming pool, never to return. I think the water still needs to settle and set before I'm ready to start obsessing over growth numbers here and there. Don't get me wrong. I mean, things might happen in the equity market, wars, this and that, things might change. But I think that's an important consideration, that just because someone says the recession, quote unquote, is over doesn't mean people aren't feeling the after effects. That's
well said, Keith. Doesn't
Speechless.
Yeah, speechless.
why? Because I just threatened to kill you.
As I'm sitting
I'll
here,
jump in there after you, Keith. I promise.
as I'm sitting here reading the Bloom tubes. It says the headline says Goldman's Waldron warns of unprecedented economic shocks, echoing Jamie Dimon. So I mean, all the bankers seem to be jumping on, which is kind of interesting. But
That might be a contrarian indicator, by the way.
true. I never trust the bankers, so I don't know. I don't really know what to make of it. But I mean, that's certainly my view. I don't know. I just definitely feels like a time to be a lot more liquid and have some cash ready to deploy for some opportunities, which.
Well, that's the thing I think that's really important, and credit to Keith for sort of identifying this much, much earlier than I sort of had to come around to his view, which is, the markets will price this in a lot earlier than the economic data will ever. We've talked about sort of bellwether stocks in other pods, but I think it's just, again, I think the market, this is why, I've had to change my view, obviously China, the stupid COVID policy, and then Russia invading Ukraine, which by the way, I don't think we talk about enough on this podcast, largely because we don't really know what's going on. But I think that we don't discuss sort of the effect on, wheat prices, which refuse to go down despite the global growth fears.
Fertilizer.
Yeah, I mean, one of the charts that I've been really what I've been looking at is sort of the interplay between industrial metals, which are inextricably linked to growth, and wheat and other grains. But let's just use wheat, for example. And while China was locking down, industrial metals basically fell off a cliff, still pretty high, but absolutely rolled over. And net wheat prices just kept on going up. You say, well, Rich, why does that matter? Normally, the whole commodity space will rise and fall together depending on growth and expectations of growth, et cetera, et cetera. And for that dislocation to continue, which we can share with the viewers, I mean, that's, I think, a really kind of a fascinating wrinkle and something that I'm continuing to keep a really close eye on. Well, I don't know, Steve, if you had it.
Well, yeah, no, I just remember you saying like earlier in the show, which is a great quote. I always tend to think about this a lot, which is like, if you're not, when the facts change and you don't change your mind with it, like you're kind of just a stubborn idiot, right?
Well,
so I remember like when we did the I think the first show in January, we kind of did like the year-end show and like predicting, like this is the time when like Scotia was coming out with their rate hike forecast and all this stuff. And we were kind of like, well, listen, like it's 2 to 3 hikes. Like, again, when the facts change, which was like in February, Russia did a full-on invasion of Ukraine. And all of a sudden, you're choking off one of the largest exporters of oil and gas. And not only that, but whatever, everything else that Russia basically exports, which is like, the huge bulk of the commodity market, fertilizer, the whole green car revolution, that all that like depends on Russia basically being, complicit and supplying a lot of these precious metals. And so, that was obviously a highly inflationary event, because I think going into that year, right, everybody said, well, like based on sort of like our forward metrics here, the inflation should peak roughly around Q1. But then again, you have this like full scale, war basically breaking out, and the facts change. And so, and then just seeing how central bankers are reacting to that, right or wrong, how they're reacting to that is by, trying to kill this, I think, commodity induced inflation by hiking rates. So yeah, I think you have to sort of change your facts. And that's why we did this Q&A or whatever, this bet last week, right? We all had 50 basis points on the Twinkies here to raise rates. And I wouldn't be surprised if they go another 50 here in July, because that's just what they're going to do until something breaks.
Like some of these, like the whole movement in the energy sector is like a lot of that happened before the Russia-Ukraine war started. And a lot of it has been driven, as Rich has pointed out so many times, it is driven by climate change policies. And then, the weather is also changing. It's affecting on the agricultural yields. When fertilizer prices gone up, nat gas being burned off, all that stuff. And what's great though about that from an investment perspective, there are ways to play it. We've been adding to agricultural commodity exposure now over the last 7 to 9 months probably. And these big turns that you see happening. It's not something that is good for 1 month and then it's over. And you're able to identify, hey, this is a big secular change that's taking place. And then as an investment manager, you decide we want to allocate this amount of the portfolio to that space. And we're going to do it in sort of in these different tranches because there is going to be volatility along the way. But this, even if there is a peaceful solution over there, and I'm not seeing any signs that's being suggested. So that tells me that it will be the status quo. It increases the probability that energy prices, agriculture prices, and then inflation as well, from the commodity side, it's going to go higher. So again, from the investment side, there are opportunities here to protect your savings, even grow a part of the portfolio outside of the traditional, equity.
60-40, baby.
60-40 is.
What is that? That's the balanced portfolio?
Yeah, that's what Canadians have been sold now for 80, 90 years.
Bonds.
Sorry. During the 80s and the 90s and NDOs. Yeah.
I mean, that's the tough part about us ragging on it now. For a long time, it did really, really well. When you have interest rates go from 20 to 0,
absolutely,
bonds makes you look like a genius. And I think that the trick now is to say, listen, we're in a regime shift. And it's always tricky, right? Because everybody's always desperate to be the first to plant their flag at the top of the hill and say, well, I'm the one who identified the regime shift. I'm less interested in being first than I am being right. And I think that there were people who were on this oil thing before I was. There's people who are on this end of the bond bull market thing before any of us were. I think it's hard to disagree. Now we're in like the second inning, I think, of this sort of regime shift. This is not I don't think we're first. And I think it's important that, we could be wrong. But I think we're definitely in the second or third inning of this like new regime.
Rich, I'd be curious your thoughts on, I think we've chatted about this before briefly on the show, but just on sort of like the labor market. And like one of the things I was having a good conversation with one of my friends in the industry here, they run massive lending book in the real estate market and like commercial. And they've got like rents, like their forecasts on rents are sky high. Their forecasts. And like, so I was going to ask you in terms of like, because I'm already seeing it like in the rental market here, it is insanely competitive right now. It's way harder than the resale market, obviously. But like how much of this comes back down to the labor market, obviously wage growth picking up because like people are trying to like, renegotiate their salaries, et cetera. But also the fact that like a lot of these boomers have now left the, Keith, hasn't left the job market yet, but a lot of them have, and a lot of them are never really coming back. Right. And that's a huge demographic shift. So do you foresee like, recession or no recession? Do you foresee like just tough to fill a lot of these jobs moving forward and like the upwards wage trajectory? Like, are we basically is the bargaining power coming back to sort of the worker or the laborer as opposed to the corporation?
Yeah, I mean, man, that is a tough one. I think there's a couple of things. I'd like to split those into two, if that's okay. One is the rent thing. I think the rent thing is directly related to immigration. I think when you come here and you don't necessarily have a bank account or you don't have people with, if you're in the 1%, you're probably staying wherever you're from. I think if you're coming here, you're probably getting on the lower end of that pay scale. I could be wrong about that, but you're coming here, you're renting. And I think that the massive immigration, I think, is directly playing into that, especially in the cities where everybody goes to, right? Let's be clear.
Record immigration in Canada in Q1, by the way.
Right. And I think that's not going to stop. And I think that's the first, I think that's one one thing of it. And then on the labor side, I'm of the view that countries like in the US, where there's very little immigration relative to history, and you do have a demographic kicker, which is, we've talked about this before, which is the age dependency ratio. So less working age people relative to the old and the young. I think wage growth is going to be structural. It's structural for two reasons. One, you literally don't have enough people, but also the people that you do have you're mismatched, right? We've discussed this before. There's not enough bricklayers, and there's too many people who've done, trying not to get in trouble here, have done degrees in universities that may or may not be as useful or productive as they thought or were told. And so you have the skills mismatch, which is the short-term, like acute labor shortage stuff. But I think that there's the real kicker for wage growth is the demographic thing, where you have a lot of people retiring and you don't have enough people to fill those jobs. And the problem is those people who are retiring hopefully don't die right away. They go and spend. So you still have the demand quotient, but you don't have the labor quotient. But in Canada, it's weird, right? Because you have a lot of people coming in to depress those wages. Although I don't know, I've been told that's not strictly true. So I'm still trying to figure that out. But in general, I think that there is going to be an updraft for wages. I do think that labor, that's been trounced and has gotten less and less and less and less of the pie for basically a generation. Maybe I'm too optimistic. I get criticized for being too optimistic, but I think that the labor is going to eat more and more and more versus capital. And that happens when you have interest rates rise. You have, more leftist governments, for better or for worse. You have literally labor just has a better negotiating position today than it did 20 years ago or whatever. That's sort of the way I see it. I think there's a bunch of things that are interplaying, right? You've got skills mismatch, demographic, structural stuff. You got the immigration that's been really, really high here. It's just, and then of course, you've got the automation piece that comes in and kind of mixes the whole paint canister up and screws everything up. And is automation good for wages or bad for wages? There are people in South Korea who would say, and there's beautiful papers written on how automation is actually really, really good for wages. And you say, how does that make any sense if you're taking, and then there's other people who disagree. So it's a really confusing subject. Obviously you can tell I'm not exactly clear. Well, but the age dependency ratio, I think, is the big main driver of a lot of this stuff.
I mean, I think it just comes down to, in general, trying to predict like macro, right? Like it's fun here to sit here and like discuss it and sort of, I think we can clearly see the 2 to 3 month trajectory, but like as you start getting further out, like these are such complicated dynamic systems.
Yeah. But also don't think that the mistake I think people make is there's two mistakes I think people always make. One is that it's only just one thing. If you nail this one thing, then you forget everything else. That's silly. And then the other thing is that the other mistake I think people make is that, each country is slightly different in a way. And so the US, for example, has very, very low immigration for the first time relative to Canada. Right now, it's, the US has very, very low immigration, and Canada has much, much, much higher immigration.
I think the numbers, I think the numbers last year were, so I think Canada immigrated about 400,000 people. And I think the US was about 500,000 for the US. And the US is 10 times the size as Canada. So Keith, I don't know if you have anything to sort of add or chime in there, but
so I mean, these are, like long-term waves, longitudinal waves. Is that the right word for it?
I don't know.
Something like that. Okay. But again, like, I'm an investment manager. We were always looking at a bit short of a time frame for some things, but our biggest concern right now, and it's anecdotal, like the inflation bite that's being taken out of lower income households, it's extraordinary, guys. Like it absolutely is. So if a family, just say they're spending, say it's $1,000 a month on groceries before, like that has to be at least $1,500 a month now. Like it's things have gone up. It hasn't gone up 8%, like what they're telling us out of Statistics Canada and stuff like that. And with gas prices going up and companies, they're desperate to get people to work at minimum wage. Like you go to the stores and like it's they can't get anyone to do those jobs. So prices are also going up. I just think we are headed for this point where demand or discretionary income is not rising. So therefore, aggregate demand is going to slow as well. And I know immigration coming in, helps to keep the aggregate side up. But again, I just think we're headed potentially for this growth scare that it's not being discussed in either at the banking sector level. Remember last week we talked about the banks' earnings that came out, and we sort of talked about what they were provisioning for the loan portfolios and stuff like that. So right now the banks are thinking, hey, there's nothing here to be worried about. Like there's no hurricane coming, as Jamie Dimon pointed out, down south of the border. So I think that is a potential for a surprise on the economy. And it will be very favorable for the bond market if this would happen. Because again, like people are not expecting it at this point. And we always look for contrarian positions to put in the portfolio. So the long bond is one of them.
I think it's a great point. I think just to add here to wrap it up. So Keith, you just, mentioned the, households, especially lower income households, obviously really getting hit hard by inflation and not having a lot of discretionary spending. So if we just look at, for example, the most recent rate hike here, so 50 basis point. So just on your typical mortgage. So if you're a homeowner in Canada, again, I think the National Home Price Index, which the national home price averages about $870,000. So let's just assume you have a $700,000 mortgage. That would sort of be like your average mortgage size, I suppose. If you're purchasing today, obviously we know people bought a long time ago as well. But so every 50 basis point rate hike increase would adjust your variable rate mortgage by about $25. So for every $100,000 of mortgage that you have, it adds about $25 to your monthly payment. So what I'm basically saying is if you have a $700,000 mortgage, you're adding about $175 per month just on that 50 basis point rate hike. So $175.
And that's in addition, to the grocery bill gone up and the energy bill gone
exactly.
up. Like another good data point. Sorry to interrupt you there. If you look at revolving credit, which is looking at basically credit card, debt that you're looking at, in general, lower income households, that's how they get by using credit cards. Higher income households, you use your credit card just for the ease of transactions and collecting points on stuff, right? That's it. But the growth in revolving credit, this is on the American side, Rich. I'm sure you can check out the Canadian side. I'm sure it's very similar.
It's the same.
It's increasing exponentially. So if something happens along the way where this group is unable to make the payments, or they have to get, lie on an application to get another one, like there's a big potential debt loss coming up, which is something we didn't. I know earlier this week, I think it was Steve or Rich when you guys sent it to me, that the Americans are considering writing off, I think $10,000 of every student's
$10,000. Yeah, Biden's was apparently they were going to announce it prior to, well, then that shooting happened at the school there, unfortunately. So they apparently postponed it. But it was a $10,000 loan forgiveness for every student loan outstanding, $10,000. So, it's funny, people always used to laugh at me and say, oh, Steve's idea of this, debt jubilees. This is, we talk about financial repression and debt jubilees. That's a debt forgiveness. Like, I know it starts there, but maybe in 5 years, it's 20 grand, and maybe it's,
but it's not really a debt for, in this one here, the debt just simply shifts from the students to the rest of the taxpayers. That's all it is. Like, it hasn't. Yeah.
But you can argue about like the semantics and the mechanics of it. Like, I'm not advocating for this as like good policy, but like
I might.
I think
I said that. I can't believe we'll save this for next time. I can't believe I said that, but I actually might have changed my mind on this. But keep going.
Well, I do think, Rich, that it's absolutely insane in the U.S. that student debt is not forgivable. Period. It's like if you go through bankruptcy, it stays with you for life.
Yeah, that's stupid. All other debt is forgivable, just so people understand.
Why did that happen? How did that happen?
I don't know.
Probably all the big universities there said no. no chance. I don't know. Wall Street obviously makes a lot of money off those loans.
Yeah, you can research that one offline. But I think that's not the whole episode.
That's
really.
a can of worms.
Well, but the whole thing about the effectiveness of the whole academia and how it's put together and structured.
That's the counter argument, because they just don't realize how inefficient getting all those unmentioned degrees might be.
Like I
have some comments on this, but I don't want to get kicked off of the show, so I'm gonna keep them to myself.
Like I can frisbee a pizza at 2 universities, from my front lawn. That's how close I am. And the last 2 weeks have been graduation week down in this part of the country. And I see all the students with, it looks like it's such a great time. 3, 4, 5 years they were in doing degree, and I'm just wondering, like, what did they do? How much did it cost, and what's the economic output of it at the end of the day? And some of it is not measurable. Absolutely. I mean, education is education, because universities will say, well, we're educating you. We're not training you for a trade. You have to go beyond that.
They're not even doing that anymore.
I'm to the Loonie Hour, free education.
Yeah, I know.
No charge.
But it's gotten to a point, though, where the cost benefit analysis, something is just not quite accurate, where in Canada, 4 years, maybe you come out with, if you had to, fund the whole thing, it could be a 50 to 70 grand, bill if you're all done. Like if the kid is staying on campus and all that stuff.
But this is the breaking, and this is the breaking of the social contract, right? Which is like, think about it as a kid, right or wrong. Like maybe you're the idiot for believing in that, but right or wrong, everybody was brought up told that go to school, get an education, go to university, get a good job, and then you can buy a house, raise a family. And it's like, well, everyone's like, well, hold on a minute. I did all that. I went to school. I came out. I'm still not getting paid enough. I can't buy a house. I can't afford to have kids. It's like, and then that's why you're seeing, I think, all these like social and political tensions, because to me that.
Wait a second. The contract is that if you educate yourself in something useful, you don't have to go and do, I really want to say it, but I won't say it, a degree that wouldn't necessarily be, how do we call it, useful in a non-bourgeoisie society.
It comes down to expectations, right? So if you become educated in the field and your expectation is that you're not doing it to generate your own wealth or income, it's to truly, it's at that educational level, that's fantastic. But I do know that when I bump into people, they've gone through academia and multiple degrees, and you hear what the degree is in, and then the income expectation on their side, it's completely out of whack with what it would be from a business side, because 3 of us, we run a business. And if one of these guys came and knocked on ice cap doors, I have these 1, 2, 3 degrees in this, and I expect to get paid that, I'd say, I'm sorry, pal, go to the bank and see what they're going to do. And you know what? The bank is also going to tell them, to go somewhere else as well. So anyway, it is difficult.
But you were touching on something really, really important. It's not just business; it's what society needs. Society needs right now, let's just say, for argument's sake, bricklayers and welders. That's what society is telling you they need, and the way by which society is telling you this is a signal. And what is that signal? The signal is a pricing mechanism, supply and demand, and wages for that specific role are skyrocketing. And so when people are basically patently ignore the signals that they don't want and go do degrees that we don't need. And so I don't think it's just about business, although you're right to make that a point. Society more broadly is saying perhaps you don't need to understand certain concepts to be constructive and to help your fellow man. And I think that's you were.
Canada needs more realtors, the backbone of this economy.
You're probably right about that.
Oh man! All right, well that's a good place to wrap it up.
The mortgage-backed security is the backbone.
I tried really hard to
watch. I'm gonna get all these like emails how to get your real estate license. No, as always.
Wait, there's a license? You have a license?
Yeah, it takes about 2 weeks. No, it's a little bit more strenuous than that. But yeah, this is the Loonie Hour University here. So we appreciate your support. As always, all we ask is that you share this episode with at least one friend or family member to continue to grow the Loonie Hour community organically. So as always, we'll see you next week.